Have you ever stared at a $20 bill and wondered where the hell did this come from? I mean, it's not like it just appeared out of thin air, right? I mean, it's not like trees have little $20 branches just ripe for the picking. You won't find money growing on trees no matter how hard you look. The truth is, the creation of money is a bit of a magic trick, a sleight of hand that's both fascinating and complex. And like all good magic, it's all about illusions. And banks. Banks play a crucial role in this grand illusion, making money appear and disappear in ways that seem almost mystical. Yes, those buildings you walk past every day hold the secret to how money seems to magically appear. Inside those walls, a complex dance of numbers and transactions takes place, creating the money we use. Buckle up because we're about to pull back the curtain on one of the most important yet least understood processes in the financial world. We're diving deep into the mechanics of money creation, a journey that will take us through the corridors of power and the vaults of banks. You see, money starts its life in a rather mundane way. It's printed by the government, but that's just the beginning. The real magic happens when it enters the banking system. When you deposit money into your bank account, it doesn't just sit there. Banks use your deposits to create loans, and this is where the magic really starts. Through a process called fractional reserve banking, banks are able to lend out more money than they actually have in reserves. This means that for every dollar you deposit, the bank can lend out multiple dollars, effectively creating new money. This newly created money then enters the economy, allowing people to buy goods and services, invest in businesses, and stimulate economic growth. But it's not just about physical money. In today's digital age, most money exists as numbers on a screen. Electronic transactions, credit, and digital currencies all play a role in the modern money supply. Mobile banking and online transactions have made it easier than ever to move money around, further blurring the lines between physical and digital currency. Central banks also play a key role in money creation. They control the money supply through monetary policy, influencing interest rates and the availability of credit. Understanding how money is created and managed is crucial for making informed financial decisions. It affects everything from the interest rates on your loans to the value of your investments. So next time you look at a $20 bill, remember the complex journey it took to get into your hands. It's a journey filled with magic, illusion, and a whole lot of financial wizardry. And now, with a better understanding of where money comes from, you can appreciate the intricate dance that keeps our economy moving. Stay tuned as we continue to explore the fascinating world of finance, uncovering the secrets that make our modern economy tick. The secret sauce in the money creation recipe is something called fractional reserve banking. Fancy name, simple concept. Imagine you're a bank and someone deposits $100. You don't just lock that money away in a vault and call it a day. Instead, you hold onto a small fraction of that deposit, say 10%, as a reserve, just in case the depositor wants to withdraw some cash. The other 90%? Well, that becomes available for lending out to other customers. This is where the magic starts happening. Let's say Bob wants to start a cupcake business. He needs some dough, pun intended. He goes to the bank and asks for a loan, and the bank, flush with that 90% it kept from your initial deposit, lends Bob $90. Now here's where it gets interesting. Bob's got $90 in his account, and you've still got your original $100. Wait, what? That's right, through the magic of fractional reserve banking, the original $100 has seemingly multiplied. This process doesn't stop there. In fact, it's just the beginning of a fascinating journey through the world of fractional reserve banking. Imagine a single deposit setting off a chain reaction that ripples through the entire financial system. Let's say Bob uses that $90 to buy supplies from Alice. Bob's purchase is just one link in a much larger chain. When Alice receives that money, it doesn't just sit idle, it becomes part of the next phase in this ongoing cycle. Alice deposits that money into her account, maybe at a different bank, but bear with me. This deposit is crucial because it allows the bank to continue the process of money creation. Each deposit is like a seed that can grow into a larger financial tree. Now, her bank gets to play the fractional reserve game too. This isn't just a game for the banks, it's a fundamental part of how our financial system operates. By keeping a fraction of the deposit and lending out the rest, banks can support economic activity and growth. They keep 10%, $9, and lend out the rest, $81, to someone else. This lending process is what fuels businesses, helps people buy homes, and supports countless other financial activities. It's a cycle that keeps the economy moving. See where this is going? Each step in this process adds another layer to the financial system, creating more opportunities for lending and borrowing. It's a continuous loop that can have a significant impact on the overall economy. That original $100 deposit has now led to $271 in circulation, 100 plus 90 plus 81, and the cycle continues. This multiplication effect is a powerful force in the financial world, demonstrating how money can grow and expand through strategic lending. This is the money multiplier effect in action, where banks effectively create new money by lending out a portion of their deposits. It's a process that highlights the interconnectedness of our financial system and the role that banks play in fostering economic growth. By understanding this effect, we can better appreciate the complexities and dynamics of modern banking. The money multiplier effect doesn't just stop at one cycle. Each new deposit and loan creates additional layers of money circulation. For instance, the $81 lent out by Alice's bank can be deposited by another individual, who then triggers another round of lending and borrowing. This continuous process can lead to exponential growth in the money supply, as long as the banks maintain their required reserves. It's a delicate balance, but one that has profound implications for the economy. The more money that circulates, the more opportunities there are for investment, spending, and overall economic activity. However, it's important to note that this system also relies on trust and stability. Banks must be confident that their loans will be repaid, and depositors must trust that their money is safe. This trust is the foundation of the entire banking system, and any disruption can have far-reaching consequences. In conclusion, the money multiplier effect is a fascinating and complex mechanism that illustrates how banks can create new money through lending. It's a process that underscores the importance of banks in our economy and highlights the intricate web of financial interactions that sustain economic growth. By understanding this effect, we gain a deeper insight into the workings of our financial system and the pivotal role that banks play in shaping our economic landscape. Section 5. The role of central banks, the conductors of the money orchestra. Central banks are pivotal institutions in the financial world, often working behind the scenes to ensure economic stability and growth. Now you might be thinking, hold on, doesn't this seem a bit like a recipe for disaster? With so many moving parts and potential for missteps, it's easy to see why people might be concerned, and you wouldn't be entirely wrong. The financial world is complex and often unpredictable, with many factors influencing outcomes. That's where central banks come in. They play a crucial role in managing the economy, acting as a stabilizing force amidst the chaos. They act as the referees of this whole money creation game. Just like a referee ensures fair play in sports, central banks ensure that financial institutions adhere to rules and regulations. They set the reserve requirement, that 10% we talked about, influence interest rates, and control the money supply. By adjusting these levers, they can either stimulate the economy or cool it down, depending on the situation, and generally try to make sure the economy doesn't spin wildly out of control. Their goal is to maintain economic stability, ensuring steady growth and preventing financial crises. They're like the conductors of an orchestra, meticulously guiding each section to create a harmonious performance. Just as a conductor ensures that each musician plays their part correctly, central banks ensure that each financial entity operates within the bounds of the law and economic policy. Trying to keep all the different instruments, banks, businesses, consumers, playing in harmony. This delicate balance is essential for a healthy economy, where all participants can thrive and contribute to overall prosperity. Central banks also play a key role in managing inflation, ensuring that prices remain stable and predictable. By controlling inflation, they protect the purchasing power of the currency, which is vital for both consumers and businesses. Throughout history, central banks have intervened during financial crises to restore confidence and stability. Their actions have often been the difference between prolonged economic downturns and swift recoveries. In today's interconnected world, central banks also collaborate with their international counterparts to address global economic challenges. This cooperation is crucial in a globalized economy, where the actions of one country can have far-reaching effects on others. So, the next time you hear about central banks in the news, remember that they are the conductors of the money orchestra, working tirelessly to ensure that the economy remains on track and that all the different players work together in harmony. Their work may often go unnoticed, but it is essential for the smooth functioning of the financial system and the overall health of the economy. In conclusion, central banks are the unsung heroes of the financial world, guiding the economy through both calm and turbulent times, ensuring stability and fostering growth. Section 6. The limits of money creation. It's not an infinite ATM. It's important to remember that even though banks can create money, there are limits to this magical power. The amount of money banks can create depends on factors like the amount of deposits they have, the reserve requirements set by the central bank, and people's willingness to borrow. No one wants Bob's cupcakes, no loan for Bob. It's not an unlimited money printing bonanza. Section 7. The potential downsides, inflation and bubbles. Oh my, like any powerful tool, if the money creation process isn't managed carefully, it can lead to some not-so-magical consequences. If too much money is created too quickly, it can lead to inflation, where the prices of goods and services rise faster than wages. And if banks get carried away with lending, it can create asset bubbles, where the prices of things like houses or stocks become unsustainable. We've all seen how that movie ends. Section 8. The importance of responsible money management. So, the next time you hear someone say, "The government should just print more money to solve all our problems," you can give them a knowing smile and explain the intricacies of fractional reserve banking and money creation. You'll probably bore them to tears, but hey, at least you'll be armed with the knowledge that money doesn't just magically appear out of thin air. Well, not exactly. Section 9. So the next time you see a bank, remember, behind those marble columns and intimidating vaults lies a system that plays a vital role in our economy. It's a system that, when managed responsibly, can fuel economic growth and prosperity, but, if left unchecked, can lead to instability and hardship. It's a delicate balancing act that requires careful stewardship from both banks and policymakers alike. And who knows, maybe you'll even start seeing those $20 bills in a whole new light. Just don't try asking a tree for a loan, that's just silly.